Hello and back again for a new video. This one is definitely a little on the late side, which I'm sorry for, but I've been very busy with a trading strategy testing that's been going quite well. So hopefully I'll make another video about that a little later and show you kind of my testing methods and maybe why they take so long and why I have to put them as such high priority over making any sort of small videos. I'm going to start this video a bit differently than I start just about any other video, with actually giving real, true financial advice that I can call financial advice and stand behind. These are just basic sentences, basic quotes, kind of, that do apply to anyone and everyone, regardless of your income levels, your financial goals, your age, things like that. First of which is that the market can remain irrational much longer than you can remain liquid. So things like when interest rates go down, typically the market rises because interest is now loans are now cheaper, which makes it cheaper to get money and invest in things, for companies to make big investments into their company and grow, which usually leads to higher revenues, higher profits. Um, and then when interest rates rise, vice versa is typically true. Since those loans are higher or more expensive, it's harder to make investments and get higher profits. So, like 2018, 2019, interest rates were on the rise. Actually, more like 2017, 2018. But interest rates were on the rise, and we had some of the best years in stock market history. So that's irrational, but it's what the market did. And then interest rates in the last couple of months, around that February point to March, during that major crash, interest rates went from 1 point something to zero, which should be, market's going to go up. And then they continue to drop another 10-15% very quickly. So people that went with the rational thing in the short term to even long term and lost a ton of money, and pretty quickly, especially in this last case. If they went bullish when interest rates went to zero, the market continued crashing another 10-20%. If they held through that, then they made the money back eventually in May and June and July. But they had to hold for a while, and they had to take a huge loss in the beginning. Then that brings me to the kind of the second point, is that never deny the reality of the situation you're in, which is even good life advice, not just investment advice. But the reality of the situation is that even though many businesses are hurting, many businesses are closing, real estate is not as in demand as it was. Some businesses are cut to maybe 50% capacity, 25% capacity, things like that. That would kind of tell you that the market should go down. Market shouldn't be hitting all-time highs, shouldn't even be near them. The reality of the situation is that we're about 100 points away from all-time highs, maybe 5% away from all-time highs. We're really not all that far from it. And we've came a long, long way in that process, a volatile long, long way, with all these ups and downs in the process. But that is the reality of the situation. Every time we dip, the market just comes back. People buy it back up, and the valuations go higher. It dips, they buy it back up, and valuations go higher. It makes support, higher support, forms a higher resistance, and then breaks through that resistance and makes another higher support and another higher resistance, and so on and so forth. And it can do that for quite some time. So that's the reality of the situation. So that brings me to kind of where I'm at in this video. So now I want to say everything going forward is not investment advice, not financial advice. That type of stuff does take into account your age, your income levels, financial goals, retirement goals, whole bunch of other things that I know nothing about, the people watching this. So I always encourage you to talk to a financial advisor to make a basic financial plan that has those long-term goals in mind, and a decent plan to reach them as time goes on over the next 1, 2, 5, 10 years, whatever you're doing. What this video is, though, is just what I see in the market going on, kind of short to medium term lengths, and what I'm doing about it to take advantage of it all. Okay, now the last video I made was over a month ago. It was around like June 15th, I believe, so around this area. I was still hedged by maybe 10 to 20% of my account was hedged. So I would, if markets were to drop, not all my account would be at risk of it. Good portion of it would just stay flat, and I'd only take a portion of that hit. So markets tried to drop here, and they tried to drop here, but what ended up happening was a support was made. Oh, jeez. A support level was made right here. And this support actually still matched up with support all the way back there in March. And furthermore, there was resistance previously at this level. Resistance. Then it broke through and made support. When you see a previous level of resistance become a level of support, this is a strong line in the sand that you need to pay attention to. And well, it happened again up here. There was a point of resistance, which also goes back all the way over here. So this was a point of resistance. Found resistance again at this level, right here, and then rose above it to make support at this level. And once again, had some resistance here. Oh, the other line. Had some resistance up here at this point. Had some resistance up here at this point. Broke above it. And now it's finding support at that level. Right here. So my last change was a couple weeks ago. It was right at this point here. I'm going to pop an arrow. Bam. What happened was, if bears didn't take control and start to drop valuations, making the market drop or as a whole, then I really had to say, I had to deny that the reality that I was seeing, the hurt businesses, the 25% capacities, the higher credit tightening, it's a little harder to get loans, things like that, isn't going to drop the market. At this point, I really had to call kind of BS on myself that I'm wrong, and I couldn't deny the reality of the situation any longer, because it kept trying to drop, and it found resistance, and then got bought back up higher. Tried to drop, got bought back up higher. And at this point, it was just the last straw. If bears didn't take control here, then they just weren't going to take control until maybe later in the election. So maybe October-ish, late September. My stance might change based on what the market tells me. But since the market's telling me that every time it drops, it gets bought back up and makes a new higher level of support, breaks through resistance, that resistance becomes support, and so on, all the way up, just grinds higher, I had to get rid of my hedge and go pretty much fully into the stock market. But of course, my rational thinking doesn't agree with the market going up, so I'm just in it for market performance. I'm not leveraged in any way, shape, or form. Besides maybe that small position I've talked about in that DFEN, which honestly is at this point like a side account. I just have that waiting for the next 2-3 years till it doubles or triples, whatever happens. Around $45, I'll sell that, but that's on its side. I'm kind of not even paying attention to that. I'm just waiting. But the rest of my money, though, is going to be right now market performing. And for these reasons I said, I can deny the reality of the situation any longer because it kept going up. And the reasons for that could be so many things. Federal Reserve's dropped interest rates to zero. Federal Reserve is buying bonds. So if any company is in trouble and has a halfway decent credit rating, they can just sell bonds to get themselves out of trouble, and the Fed will buy those bonds, and they're out of trouble. On top of that, like, interest rates are so low. If you need to invest in something right now, you have the choice of investing in a CD or some sort of Treasury Bond and getting 1, maybe 2% at most. While if you're investing for any period of long term, 1, 2, 3 years, the general return you'll get in the stock market, even at all-time highs, is likely higher than the 1-2% a year. So if people are investing money, a lot of them are going towards the stock market right now, rather than bonds or Treasury bonds or CDs. It's just because that's the value of time and money, and it beats 1-2% easily. So since the stock market is the default place to invest right now, in order to beat 1-2%, which isn't too hard, a lot of money goes into the stock market. And that is driving prices up, as I said, so that's where I'm going. I'm in this SPY, pretty much all my money that's free is in the SPY, except that little bit that's in DFEN, and a little bit that is in gold. Now, since I am making this video late, I do kind of have to apologize. People at this point can't take advantage of gold because I was pretty spot on. I had bought gold around the 15th as well, when I went from being hedged on my accounts versus the SPY to going full in. I put a little bit of money into gold, And I also sold Bitcoin, which actually Bitcoin was a mistake. I'll get into that, I guess, later. So yeah. So around that 15th point again, I bought gold, and since then it's gone up almost 10%. Actually, yeah, about 10%. I'm going to probably sell this around 2000. It will most likely keep going above that because inflation, all the things I've been saying the last few videos, as inflation takes hold, the value of a US dollar, which gold is priced in, buys less and less gold. So the dollar cost of gold has to go up higher in order to match that. It's not that gold is getting more valuable, it's just that the dollar is getting less valuable and you need more of those dollars to buy the same amount of gold, which is inflation. So this is basically my huge hedge against inflation, and it's done quite well last week. And again, this is something I've seen in the market. Like, it had a huge point of resistance. Let's do a trend line. Huge point of resistance here for almost a week, maybe in a week and a half. Then broke above it, and that's when I got in. Around this, just when it broke over 1800, and now we're touching 2000, pretty close. Probably like Monday we'll touch 2000. And now let's move into the treasuries. Again, kind of the same thing. There's a large place of resistance right here, and around the 15th it started to break above it. 15th and here the 20th it broke above it, and this is telling me that bonds are going to rally as well. Again, the Fed has been buying bonds with their unlimited bank counts, so this should happen. This be surprising if it didn't. So this is one of the markets that's actually behaving rationally. So bonds are going up, which is typically a sign of bad stock markets. Gold is going up, which is also typically a sign of bad stock markets. But the stock market's also going up. This is what some people call an everything rally. At some point, one of these things has to break. Typically, it's the stock market, since that's actually, believe it or not, the smaller. Somebody add some trading view. I'll fix this, I think, next video maybe. But typically, that's the stock market. When all things go up at once, the stock market is actually the lowest or the smallest market of all of these compared to gold, which is a worldwide market. The bonds, which is how basically the nation runs, and that's GDP. That's much larger than any individual company or most individual companies put together. So one of those things will break. Typically, the stocks will, but it also is a sign that inflation is happening. So all the value of them is the same, but the US dollar buys less value as inflation happens. So that means all these values go up higher dollar-wise. They still are just as valuable as they were, a month ago, a few weeks ago, but dollar-wise, they cost more. And that leads to an everything rally. Before I go into the Bitcoin, which I did sell, I just want to talk about this chart. This comes from the Financial Reserve. Actually, they, I guess, put this up. All in all, though, it's just a small equation. It's the 10-year Treasury interest rate minus the 2-year Treasury interest rate. This is often looked at as a sign of a coming crash. So around August 27th, 2019, it went under zero. So the 2-year Treasury interest was actually higher than the 10-year, which is not how it should be. Typically, you need to be paid more interest to hold your money in something for longer. So a 10-year bond should have more interest than a 2-year bond, always. But obviously, it wasn't the case for this. So what this tells the market is that a coming recession is happening, which is marked off by this shaded area, which we can go back to like 2008. Yeah, 2008 is the last time we had a shaded area because that was the last recession. One before that was 2000 here, the dot-com bubble crashing. Yeah, see, it dropped under zero before 2008, then bam, big recession. Dropped under zero before 2000, and then bam, big recession. Now, when it is above zero, that is a mark for healthy markets, that we should see higher prices in the coming future, which is why we typically see them above zero in recessions, because recessions don't last forever. The Fed changes interest rates around, does a lot of things with money that cause inflation and kind of just causes inflated prices, which then marks the end to a recession. Is it true? Not necessarily, but that is the reality of the situation that we are in. So why deny it? If you deny it and keep your money out of the stock market because you're afraid, you're going to miss out on all of that inflation that happens, and your $1,000, which now only buys $700 worth of value, is going to stay $1,000, rather than being in the stock market, rising with that inflation, and turning into $1,400 to buy that now $700 worth of value. So all in all, I want this video to tell you that in order to counter inflation, you need to be invested. Don't keep your money out of the market. Don't necessarily keep your money just under your mattress, because that is a surefire way to miss out on inflation. Keep your money flat instead of gaining, and it'll buy much less in the future as inflation takes hold over the next couple of years. So that's the major thing you need to be watching with your finances, and go talk to your financial advisors about that. They can hopefully lead you in a way that's more tailored to your financial goals, as I've been saying all this time. Now, last, this is kind of a spur of the moment thing. I sort of put a chart up beforehand. But why did I get out of Bitcoin? Oh. I got out of Bitcoin again around that July 15th point, which kind of sucked because like a few days after that, it shot up a nice 10%, so I just missed out on that whole thing, but whatever. You won't catch them all. Yeah, so again, July 15th, July 20th, that's when I got out. The major reason was I originally got into Bitcoin because of the Bitcoin halving, not necessarily because I like Bitcoin. I honestly don't that much. So Bitcoin halving happened around May, early May, I believe it was, mid-May. And I figured if it was going to rise as a result of that cut in supply, without any cut to demand, it would have happened by now, which obviously wasn't the case. It kind of stayed flat. I did thankfully make money in the trade. I bought it using this GBTC symbol, this Grayscale Bitcoin Trust. I bought it around $8, I think around this point. Yeah, I think this point. And I sold it around $12. I sold half of it, and the rest I kept until about July 15th and sold that around $9. So all in all, I made money. Just kind of sucks that if I waited a week or just held on or something, I'd be up another 50% on the amount that I held. But, like I said, can't win them all. So that's the reason I sold Bitcoin. Then I moved into gold. Gold did well, I guess, as too, but of course it didn't jump up 50% like Bitcoin did. So, oh well. I think that's really all I have, actually. So I'm out of Bitcoin now. I'm fully in the market with the SPY, just no leverage, nice 1-to-1 with market performance. And I have a little bit of gold until it hits 2,000, which it is a tiny stone's throw away from, like $20, $30 away from. So I'll probably be out of that this coming week, I hope. Man, TradingView's ads are ridiculous. Oh my god. And I think with that, I'll leave you. I'm going to have 2 videos probably coming up. I want to talk about this stock soon. This is Shift4 Payments. It's an IPO I got involved with when it opened all the way back in June 8th. Got in a nice $34, and it's been doing quite well, honestly. I mean, it went up to 46 for a minute, went back down, held support again, and now it's on its way up. And I'll tell you why I got involved in this IPO. I want to do a video on IPOs particularly because that's actually an interesting topic a lot of people get interested in. And then also maybe talk about my stock trading strategy that I've been working on as of late. And that's going to be towards the end of when I finish it. So that's probably another, honestly, month out. I've got a lot of work left to do. But I've done a lot of work and it's been pretty significantly interesting. So I'll definitely share something with that. All right, that's about it. So until next time, hopefully I won't be 2 weeks late with the trading changes, and next time I see something like gold, I can share it with you all and someone else can jump in. But hey, whatever, there's only like 12 people that watch these things anyway. So y'all have a great day, stay happy trading, and stay safe out there.